South Africa's inflation rate fell to 2.8% in October, the lowest since the COVID pandemic, driven mainly by declining fuel prices and lower food inflation, according to Statistics South Africa. Furthermore, this drop from 3.8% in September raises expectations for a potential interest rate cut by the central bank, which will announce its decision on Thursday. In addition, independent economist Ilse Krieger noted that October typically sees fewer price changes in other categories. Stock market analyst Mushima Gama provides insights on the latest CPI data.
So the good news is the years of spending more to buy less could be gradually coming to an end. And this is because our inflation figures came out and they have dropped to their all-time low since June 2020. Now, CPI figures in September were sitting at 3.8. They've now dropped sharply to their lowest since the pandemic and are currently sitting at 2.8, thanks to falling fuel prices that have contributed quite a lot to this figure. Now, with CPI sitting at 2.8, we of course are anticipating that the Reserve Bank will cut interest rates even further tomorrow by 25 basis points, which is quarter percentage or 0.25%. It seems as if we may now be gradually entering the recovery phase of the 4 economic cycles. So we've been in the contraction phase, which comprises of low GDP, high unemployment, and high prices in goods and services. The recovery phase, which follows the contraction phase, is similar to spring in the 4 seasons. And we're starting to see the benefits of now gradually entering the recovery phase. And the best way to actually identify this is by looking at the unemployment figures. Unemployment figures were sitting at an all-time high at 32.9% at the beginning of the year, and they have now dropped in fourth quarter to 32.1%. It's a small drop, small adjustment, but it's something. And it simply means that there are more people who are employed now than there were previously, which is good for the GDP figure, particularly if those unemployment figures continue to drop. Now, remember, GDP measures the health of the economy. And if the economy is healthy and it's producing good GDP figures, then that attracts foreign investment into a country, which in turn creates jobs and employment. So we're currently sitting at a position where interest rates are low, are getting lower, which means we're going to be paying less for credit. That's a bonus. And inflation figures have also reduced, which means we can afford more now than we did previously, which is the ultimate bonus. The only thing we need to keep an eye on is then the global geopolitical unrest, because that will then impact the economic cycle. And the component it's likely to impact is crude oil prices. If crude oil prices go up, fuel prices go up, and that is inflationary, which may then just cause a rebound in those inflation figures.